Hey, it's Tom here, and welcome back to another episode of the Investing with Tom podcast. Now, in this episode, we have a couple of returning guests. Mitch and Kass Dol have been on the podcast a couple of times before. They are a husband and wife investing team out of Australia. And the first time I had them on the podcast, they came on to discuss a really, really successful hedge that they put in place around COVID. They read in early 2020 about a virus in Wuhan, China, that looked like it could be a threat to their stock portfolio. They ended up buying put options on travel companies, and as you can probably imagine, that worked out very, very successfully during a period of time where there was a lot of panic in the market, and they were then able to kind of turn around and put the proceeds from that hedge into some core kind of value investing holdings. Now, we had Mitch Kass back on the podcast in December to talk through a new hedge that they had put in place in that time to do with inflation and basically betting that interest rates would go up, which would cause bond prices to go down. Fast forward 6 months or so now, and that hedge so far has worked out extremely well. So I thought it would be a good chance to get Mitch and Kass back on the podcast to discuss how that inflation hedge has played out. It's obviously a topic that a lot of people are interested in right now, and inflation is something that a lot of people are also concerned about right now. So it was great to kind of get Mitch and Kass back on the podcast here and get their latest thoughts on inflation, as well as share kind of how it's been with this hedge playing out. It's a very, very volatile position in their portfolio, and it's grown to become a very substantial position in their portfolio. So we had a great discussion on all things inflation and their approach to hedging their portfolio around inflation. And during the back end of the podcast, we also discussed one of the individual holdings, which is a company called Ayr Wellness, which is a cannabis company which has an interesting combination of trading at very, very low multiples of free cash flow, but it also has very substantial growth. At least it has done historically, and Mitch and Kass believe it will continue to grow very fast into the future. So not a recommendation, but an interesting one to perhaps dig into if you want to learn more about that company. So without further ado, let's roll this episode with Mitch and Kass, and I hope you enjoy. Mitch Kass, welcome back to the podcast, round 3. Stars of the Big Short 2.0 coming up here in a couple of years. How are you both?
We're doing pretty good, Tom.
We're good, Tom. We're hanging on for dear life. We're hodling for dear life. It's the only part of this whole crypto nonsense that we like is the word hodl.
Hodl.
So,
Nice.
So we are hodling. Yeah.
I like it. Well, yeah, like I said, I've had you guys on the podcast a couple of times now. Firstly, we talked about kind of a big hedge you did in 2020 to do with COVID, which worked out extremely well. In December, we kind of had you on in real time talking about an upcoming hedge that you were just putting on at the time, which was to do with inflation. And fast forward 6 months, it seems to have been working pretty well. So how has the last few months been for you both?
It's been really good. It's been quite a wild ride, that's for sure. Like the rest of our portfolio has been, punched in the face, like everyone's portfolio probably has, because we're quite concentrated. But yeah, the hedge has performed really well. So at the time that we started the hedge, originally we spoke to you. We bought puts on HYG and LQD, and then we changed our mind within a week after speaking to you about it that it wasn't long enough duration, and betting against longer duration bonds made a lot more sense. So we did that. Started at 4%. And then continue to kind of learn about the Federal Reserve and learn about, how that whole system works and how their communication works. And then it kind of peaked. I think it might have been even up to 14% of our portfolio. We kept kind of adding to the hedge.
In TLT now.
In TLT.
Yeah.
Yeah, puts on TLT. And we still hold about 80% of what we originally bought. And the hedge itself is up about 500%. And that's helped our portfolio to be up about 45-50%, something like that, as of now. So we still hold the hedge. Could still go against us, but it's looking pretty good so far.
Goes against us every fortnight.
Every fortnight, it always moves up and down.
If you look at the TLT chart from December until now, you'll see like a steady up and down in my emotions.
Yeah.
It's like It's been volatile, but
It has, but
yeah,
it's worked out well.
it's been fun.
Yeah.
Yeah, cool. Yeah, I'm interested to spend a bit of time talking through maybe the psychology of this because I listened to your podcast just yesterday, and you're saying even though it's a reasonable sized position now, but that
Mm.
position on its own is moving the portfolio up and down like 10% in a day, right? That's kind of the numbers
Yeah,
you're seeing.
It
yeah,
is, and yeah, it's a new experience to have a position that big that we understand. We feel we understand so well, and we're so confident, and we don't feel we're justified in selling yet. We feel that with the quantitative tightening still really just beginning. So the process has gone pretty much from the central banks were buying bonds in the market, 50, $60 billion a month they were putting into the bond market. They actually own 40% of all of the long-term bond market. The Federal Reserve does. So, to go from that point to basically now where they're actually not buying any bonds whatsoever, pretty much, they're still buying a little bit here and there as their old bonds roll off. But yeah, we're still kind of coming in, we feel, to the main pressure point of the bond market where, real buyers are going to have to step up. And with inflation almost 9%, real people with their own money are going to have to say, yeah, we think 3.2% for 30 years is a great deal, at this point. So we're still pretty happy to hold it for now.
Yep. Yeah, nice. So maybe just a quick recap for anyone that didn't catch the last episode we did. Essentially, at the time you guys saw, so this was December 2021, we recorded that.
Yep.
I think the talk of inflation had been kind of warming up for a little while, and we were
Mm-hmm.
just starting to see it in the numbers. And your view, essentially, correct me if I'm wrong, but essentially your view was that you saw inflation um, as a major risk to your portfolio and everyone's
Yeah.
portfolio, essentially,
Yeah.
that was really probably quite underappreciated by the general market at the time. And you sort of had discovered like a relatively cheap way to hedge your portfolio where you could make a relatively modest allocation, but the upside downside um, was quite asymmetrical. I guess you were talking like potentially up to 50x kind of upside on some of the puts you were buying at the time, right?
Exactly
Mhm.
right. Yeah, yeah. Because bonds had never moved very much historically. They're a very stable, stable asset. Yeah, it was very kind of hard to see how that made sense as an investment for anyone with inflation getting as bad as it was.
And inflation was already at what, 6 or 7%
Yeah,
by
already
that
six
point,
7%.
so it's already crazy high, and that was even before the war in Ukraine had started.
Yeah,
So um, yeah, I think we were thinking, coming off the back of a housing boom where that hadn't even come through CPI yet,
yeah,
through the shelter and CPI.
yeah,
Energy costs were already going up.
yeah.
Um, yeah, it was pretty clear that the Fed was going to have to move rates from zero. So to us, it was kind of quite obvious.
Yeah. And the consensus opinion in the market was still that inflation was transitory, pretty much. And I feel like it still pretty much is for a lot of people. They still believe that it's going to come down by itself, which is something that, from our research and something we've now heard from, Druckenmiller and Bridgewater, is that inflation historically does not come down by itself. It's kind of a self-perpetuating feedback loop. And historically, to get any inflation that's come down has only come down when you've got the base rate above the rate of inflation. So, yeah, what we were looking at with those hedges is basically deep out of the money puts, and yeah, if the price was to move quite a lot, then yeah, we could have had that crazy return. I think the TLT puts, by the time we bought them, the price had moved a little bit, and I think the max return we were looking at for the TLT puts was basically like a 15x. So yeah.
Yeah, cool. And I just before we jumped on here, I did jot down some numbers on how things have changed since December. So I'll rattle through them quickly, and maybe you can give us some of your thoughts on on the changes. And
Yeah.
I'm also interested to dive into sort of the switch you made not long after the podcast in terms of how you look to hedge inflation. So
Sure. Yeah.
yeah, you're pretty much bang on. When we recorded in December, the inflation, and these are US numbers, 6.8%. The latest number is 8.6.
Yeah.
The 30-year bond at the time was 1.9%, now up to 3.3, I think, is the latest number.
Mm-hmm.
HYG, which is the high yield bond ETF you were short at the time, has gone down 15%. LQD, which was the other bond you were short, is down 18%. And TLT, which is the bond that you switched to not long after the podcast, is down 25%.
There you
So you
go.
pretty
It
much
worked. I'm
nailed it.
happy we switched.
Yeah, no, we're definitely glad we switched, and that may not sound like much of a difference, but when it comes to options, those extra percentages really make a big difference, and that's probably the difference between like a 2x and sort of 5 to 6x we have at the moment that we're sitting on. So yeah, we're definitely glad we switched. It's good changing your mind when things don't make sense. It's good.
Yeah, 100%. So, can you just spend a couple of minutes maybe talking us through why you made that switch? Is it purely a duration thing? I mean, a couple other data points I jotted down from the last podcast was average bond duration for LQD was about 10 years.
Yeah.
HYG, which is a high yield ETF, was about 4 years. And I think TLT is like a 20-year plus ETF, which is what you're short now.
Exactly right. We were both thinking at the start that the fact that it's quite junky debt was a bigger factor than it probably ended up being in our minds. I think in the end we realized we were kind of betting on the economy going bad, and that's a very hard thing to predict. It's still, I mean, everyone at the moment feels like everyone's pretty much 100% the economy is going into recession, but it's very hard to predict that with any certainty. So what we were really confident about was that interest rates had to go up, and the Federal Reserve was kind of starting this process of kind of like breaking the bad news slowly to everyone that they were going to raise rates. So I think that was the main reason, just the duration and just running the numbers and realizing that I was a little bit too focused on the fact that AMC was in there and it was bad. It was bad debt. And I really like being short things that
well, they're
good quality.
They're probably getting saved by that gold mine they bought.
Did they buy a gold mine? Did they?
I think so. Yeah.
Oh, good.
Did they? I thought
someone
they
can
connected
fact check
with
that.
Bitcoin or something as well.
Gosh.
And they like rode that wave for a little bit. But
Who
I
knows?
think we were focused too much on the junk, the corporate failures and stuff. And in the environment we're in, where there's so much liquidity and corporate balance sheets is doing so well.
Yeah.
The fact is they're probably not going to have pain for those companies for a couple of years, really.
Yeah. The strength of company balance sheets and consumers' balance sheets is the thing that's made us think that the boom probably has a little bit longer to go. There's a lot of data people cite that sort of talks about how the consumer is quite weak. And when you go to the shops and you see prices going up as much as they are, I think we feel it even in ourselves. You kind of naturally pull back your spending. But once you once you kind of get used to the fact that prices have gone up and you're not actually overpaying because this is the new price that we're going to have to pay, and actually the price is going to continue to go up, that then will probably normalize, I think, consumer behavior over time. And if you just look at the raw numbers, people's balance sheet, people's personal balance sheets are very strong. They have, I think there's good data that I always come across from the big banks in America, and they always say the average person, who used to have like $2,500 in their bank account now has $5,000. The average person who used to have $10,000 now has $20,000. Like the level of backing and of savings people have is much higher than it used to be. So I think with that in mind, that kind of swayed us away from thinking that the economy was going to collapse straight away, and actually just that the Fed was going to have to do a lot of tightening. And then maybe eventually we'll get our collapse down the track.
And those longer term duration bonds, when you're locked in for not 3 years or 10 years, you're locked in for 20 or 25.
Yeah.
There's a lot less,
You're kind of stuck basically as a buyer if you buy them.
They look a lot less attractive to people.
Definitely.
And less attractive to keep holding.
Definitely.
So, yeah.
Cool. And so I guess where to next? It seems like the hedge has been working really well so far. I think at the time we spoke in December, you had sort of a range of put options at various strike prices and various expiry dates. So presumably some of those have already expired or you've already exited.
Yeah.
Are you looking to reallocate that money back towards more traditional investments for you in individual companies? Are you looking to keep rolling this into new puts, with the idea that inflation and interest rates are going to keep trending up? Where are your heads at at the moment with that stuff?
Well, that's the thing. I mean, I guess all we can talk about is how we feel at the moment, because we change our minds a lot, because the data is changing constantly and things are always adapting. But I think at this point, let's say the yield spiked to like 4% on the 30-year, which would push us from like a 5x on the trade to a 10x. If it spiked to that point and inflation was still accelerating, and we had to sell out because the trade was going to expire, then I think we probably would have a smaller position ongoing. We've spoken about it, because we're still such a long way away from the inflation number and the bond yields. And within that is, I guess, an inherent assumption by the market that inflation is going to come down by itself, or the Fed's 2 or 3 interest rate hikes are going to push inflation down by itself, or we're going to go into a recession, and that makes bonds more attractive, basically. So it's very hard to see with our view, and we've been reading about this for a long time, 9 months almost now. It's very hard to come to the conclusion based on what we believe are the underlying causes of inflation, that inflation will go away by itself. So I think until inflation comes down, these yields are still far too low, in our opinion. And considering we're now going into a period where the Fed used to be a huge buyer in the actual market. So mechanically, when the Fed's stepping out, and we need somebody else to step in, and every week that stocks go down, well, stocks become more attractive compared to bonds. That's the kind of how it works mechanically. And we see that in the prices. So the share prices, the index prices fall, the bonds kind of hold up for a little bit, the bonds go, the share prices go. They kind of take turns crashing at the moment. So it's very hard to know where to go next. We've talked a lot about maybe it's best to just hold ground for a while until we see another great opportunity. So, we've looked at gold pretty closely. That seems like it'll probably have a place to play. We've looked at TIPS as well, treasury inflation protected securities. So basically what a TIP is just a bond, but instead of paying you a fixed percentage, so 3%, it pays you CPI plus a little bit no matter what. So, if inflation's 5%, the TIPS will pay you 5.5%. If it's 7%, they'll pay you 7.5%, basically. And the incredible thing about TIPS is that they're actually crashing with the rest of the bond market. So, around January, the return for locking your money away in a 10-year TIP was basically 0%. So, if inflation was 5%, you'd get 5%. But because they've crashed with the rest of the bond market, now you can lock in, I think it's about 0.8% above inflation is the 10-year TIP. So there is actually a way out there to lock in your money with a guaranteed inflation-protected return. So that's pretty interesting to us.
That people don't seem to have caught on to yet.
No, yeah.
It's like the TIPS are selling off the same as all other bonds.
I know.
So Mitch was saying he thinks it's like bond fund managers that are just like indiscriminately selling certain percentages of all they hold, because who else owns like big amounts of TIPS? I have no idea.
Exactly, yeah. The market seems to be segmented in like people who are fixed income managers, people who are growth stock investors, people who are like, macro fund investors. Because if they got that segmentation, you don't really have a lot of people who can just swing between asset classes and move around. So I've got, because as inflation is getting worse and bonds are selling off, you expect people to be like, oh, great, we can move our money into these bonds that are going to protect us from inflation. But so that's interesting to us. But apart from that, I think that the companies that we own, Howard Hughes, Universal Music, Fairfax India, and Ayr Wellness, they're all kind of very cheap, very secure kind of companies. And I think we probably will add a little bit to them, but I think we'll definitely, when the trade's fully resolved, we'll definitely have a large percentage in like cash-like assets, whether it be gold, TIPS, or cash, because if inflation does continue to get worse, which is not a certainty, but it's certainly a possibility, then, we could be looking at asset prices down 60, 70% still from here, just with the numbers that make sense based on the 70s. So, yeah.
Yeah, crazy times. And
Crazy.
there's no appetite not a strong appetite by the sounds of it to roll back into new TLT puts.
Yeah, it's just because they've gone up so much in price too. So the way options work is the more volatile the underlying security is, the less chance you have to make a massive exponential return. So the price that we bought in TLT puts at, if I was to replicate that again, then the return on offer would be probably half as good. So instead of offering maybe a 10x, you'd maybe get a 5x. So that was kind of the best part about this trade, is that using a small part of our portfolio, we could take advantage of the fact that bonds, had been pretty non-volatile historically. And kind of take advantage of that. But I think last time I checked the pricing a couple of weeks ago, I was quite shocked at how much the pricing of the insurance had increased, which you'd expect considering the massive car crash that's happened.
Yeah.
Yep.
I think there's like this, it's almost conspiratorial in a way, I guess. People think the Fed's going to pivot back to being dovish and, taking rates back to zero, quantitative easing again. And I think I can't see that happening. The rate of inflation that it's at, how serious Powell sounds and how they want to fight inflation. Like, he sounds serious. I can't see him pivoting anytime soon. And inflation is like 8.6. So, they're playing catch up. But if for some reason there's a massive recession and they do turn around while inflation's still around, I think that'd be a second opportunity for us to short bonds again.
Yeah, definitely.
When we can see that they're going to have to turn back to being hawkish, raising rates again. So I think that's probably a future possibility that, we might do TLT puts again.
Yeah.
But at this point, happy with what we've made so far. And I don't know, you're wanting to short banks now, aren't you, Mitch?
Yeah, I think that one of the most incredible bubbles is the housing bubble in your country and the housing bubble in our country. We live in Brisbane, so it's not quite as expensive, but house prices are so high, and the average person, unlike in America, where 70% of people have a mortgage locked in for 30 years below 4%, doesn't exist in New Zealand or Australia. So that is a very risky situation when you've got global inflation caused by, pick your cause, I guess, but global inflation that Australia really can't stop. It's coming from overseas. But if we don't raise rates in our country, then people are going to get used to that inflation, used to low rates and, high inflation, which is a bad combination, and it'll make our inflation worse. So we're kind of stuck. And the estimates I've seen, like Chris Joy is a really good predictor of property prices. He's been talking about property for a long time. And his modeling suggests that if we raise house prices by 1%, just 1%, 100 basis points, house prices should go down by about 30%. And when you run the numbers through, it makes perfect sense. That's 1%, okay? Like, inflation will probably be 7% in Australia by the end of the year. And probably if it continues to get worse and worse and worse, Australia would be no different to America in the sense that eventually you would have to get the rate high enough towards inflation to kind of slow it down at least and get people putting their money back in the bank and getting them more interested in saving instead of just spending. So the idea that somebody would be interested in paying $1 million for a house, 45 minutes out of the city, like most people do in Australia, with rates going up, 6, 7, possibly to that kind of level, even the fear of that could definitely create a feedback loop, which, you were saying before is, something that is potentially happening in New Zealand. So in that scenario, the banks would be exposed, both in the extra capital they need to raise to put aside, basically, to insure themselves against these losses. I had a little look back at the stress tests they ran in COVID. So they ran these stress tests on the banks, and the stress tests they ran were for 30% house price declines and 11% unemployment. And in that scenario, they said, okay, well, the banks will be fine. They'll be okay, but they won't pay dividends for 3 years. That's how they're going to deal with the crisis. Now, the banks are just dividend stocks, and not only that, the banks themselves on like price to earnings ratio and price to book ratios are some of the most expensive banks in the world. So, it's definitely
something we're looking at.
Definitely something fertile, but it's a lot harder. I think.
Everyone says never short the banks, so we'll have to. Isn't that like
pretty much? Yeah, but because they like your Kass always says, but they have government backing, and that's true. They do. They have government backing, and the government will never let them fail as such. But what we think about is, okay, they may not fail, but if the share prices were down 90% and they were still lending and stuff, would the government really care? So that's another area. I'm not a bank expert by any means, but that's sort of where my research has been going, and it looks pretty interesting.
Yeah, and it's really interesting, right? Because when people talk about traditional inflation hedges, one of the things that gets thrown in there is hard assets like real estate.
Yeah.
Which I guess is because you can raise rents or whatever, but
exactly.
if the cap rates on those commercial properties or whatever are coming down, that can have a pretty serious short-term hit to the value of that real estate, I would think.
Oh yeah. And that's the thing is in America, you've got a lot of people that actually are cash buyers, whereas and there's a lot of properties in America that are sort of $300,000, $400,000. People can afford that, and a lot of people are fixed. So if you've got a couple of rental properties, the cash flow coming out of those properties as rents rise is going to be incredible. But we don't really have that kind of dynamic in Australia. So yeah, it's pretty scary stuff, and the effect on the psychology of people and the effect on our economy of that could be pretty catastrophic. But it's like the bond short. What we kind of look for is we look for the thing that would stop that from happening. Not like we're trying to find a way that this happens, but we're actually trying to find, why would rates not have to rise that much? Why would inflation come down by itself? Like, is there actually a plausible argument for that to happen? And we're still kind of looking for it, I guess.
Yeah.
Yeah. Well, I want to touch a bit more on this psychology stuff. Again, I was listening to your podcast yesterday, which is great, by the way. It's Buffeting with Kass and Mitch. Is that correct? Nice.
Right,
check it out, everyone. And you were talking about how you're becoming hopefully more zen with the portfolio over time, just with these huge swings. Can you talk about maybe how that's been from when you first put the bond short on through to today? How you're thinking about those huge swings in the portfolio value?
Yeah, I don't think anyone can prepare you for a trade like this, where it's like so volatile, and you kind of just have to do it and experience it. And like, for me, I guess the big roadblock was when the war happened.
Yeah,
and it's kind of like I was hit in the face with like a really emotional situation. And it's kind of, I felt gross having to think about a trade at a time when a war's just broken out. And like that was really challenging, to just stay logical, stay rational, keep your emotions out of it. But yeah, I think we pulled through that. Like we held and tried to just look at it, facts only of what was going to affect the trade, nothing, outside of that. But yeah, I kind of at that point stepped back a bit, I think. And I was just kind of your assistant, like a bad assistant, like, Robin is to Batman kind of thing. You kind of took the reins while I just worked on
Yeah. That's what we realized, is because like I kind of handled that portfolio for about sort of 6 years, 7 years. The first 7 years we were doing things from young age, and I took all that volatility, the ups and downs, and got used to it somewhat. But even for me, this is a new thing to have your portfolio moving this much from day to day, and have the combination of something that you're so you've researched so well and you're so confident in, and to work out a way of managing your emotions while not suppressing your emotions, I would say, is what's really important. Is to, if you're feeling, that's basically how I used to handle things. I used to feel emotions and then just force my way logically through them. But with this, because it was so volatile, I think I had to accept that, yes, this is a real struggle to handle this kind of volatility, and just to accept that, basically. And then to realize that on a higher level, it sounds a bit woo-woo, I suppose, but on a higher level, first of all, you're lucky to be alive, okay? You're lucky to be conscious. It sounds really high level, but it really works. If you think about all the billions of years that went by before you even existed, and the billions of years that are going to go by after you've existed, you're alive for this brief period, basically. And we're lucky enough to be interested in investing and to have the opportunity to do this and to be involved in something so fascinating. And every great investor has gone through periods of incredible volatility, ups and downs. It's part of the deal. And you really have to realize that, which I guess we were forced to realize, weren't we? That, look, it's just money, and it's just money. And you have to be okay with having drastic changes in your net worth if you're going to actually outperform, I think. And it's been quite freeing. And we got to a period, I think, around about March, April, where we realized that we were both extremely stressed. And we had to sort of say, look, can we continue to do what we think makes sense without holding that stress, which a lot of people do, I think. A lot of people who run businesses, a lot of people who maybe they're involved in politics, they kind of hold that stress and just kind of push through it. But I think understanding that, look, our life is we're so privileged and so lucky to be involved in this, and we have to sort of care a bit less. And that's kind of the unusual thing about investing, I guess, that we think now, is that caring a bit less about it probably makes us better investors. And it probably means that we can actually be more rational because when you care a lot, you watch a lot and you research a lot, and maybe you research too much. And you've got to be very careful and actually manage your psychological state so you are calm and so you are rational at those times when you have to be. Otherwise, you'll make the wrong choice. And that's, I think, where, coming from a carpentry background and Kass was an office manager, we've had to learn, I guess, how to handle this kind of volatility. And I think we're getting there. We're on the right track, eh?
Yeah. No, I'm doing better now. Honestly, I've gotten to a point with it where, our values can go up and down wildly every day, and it just doesn't affect me now, which I'm really proud about. But it's just a better way of doing it, because at the end of the day, it is just money. And the money for us is a tool for us to create what we want to create in the world.
Exactly.
It's just a tool. So if you lose it, well, you can make more. It's really the skills you learn that are what's valuable to you, and that's what you should care mostly about. But yeah, if you care too much about it, if you want something too much, it just adds pressures that it's not helpful for you, most of all. So.
Exactly right. Yeah.
Yeah, I like it. It's that's actually something my dad always used to say. He wasn't like a stock market investor or anything like that. But one of the things he always said that has stuck with me is, it's only money. And I really can't remember the context that he was saying that in at all. But I think, and Monish Prabhai always talks about, treating investing like a game, and has, I guess, a similar philosophy to you, that it's not, there's more important things in life than money.
Yeah.
Yeah. And I think you really learn it when, I think it happens at a later stage in a lot of people's lives, when you actually achieve some big things you wanted to achieve. And when you get there, you realize, I rushed to get here. I'm not overly all that happier.
Yeah.
It's great that I've achieved this, but now I'm already thinking about the next thing. And so you never kind of
enjoy the process.
Yeah, enjoy the process of it. You're just always trying to get to a goal. But the funny thing is, when you get to that goal, it's like, well, what was I racing to get here for? Now I want something else. It's like a never-ending cycle. So just happy with what you're doing each day, and you're enjoying the process of what you're doing.
Yeah.
That's all you really need to try and get to.
Yeah, cool. And are there sort of practical changes you've made in your life that have helped you through it? Like, not
Yeah.
checking prices as much, taking one of the dogs I saw a tail before pop up in the background, taking one of the dogs for a walk, that type of stuff, playing the guitar. I see you got a guitar back there. Those types
Yeah,
of
lots
things.
of that. Lots of that. Actually, that doggy wants to go out. I'm just going to let her out,
Let her
and
out.
Mitch can answer
Go
that.
Go
for
for
it.
it.
Yeah. Yeah, like there are some practical things. So we stopped drinking coffee, which is actually, I'm sorry for everyone who loves coffee out there. I'm not insulting your religion or anything, but for us it was, and we don't drink a lot of coffee, but for that we realized after we stopped, after 2 weeks, that basically it was affecting our sleep. So our sleep wasn't as good. So our sleep now is a lot better, and that helps you to start the day in a very kind of emotionally neutral, relaxed way. We do meditate every day now, which has helped a lot. Helps you to realize how much activity is going on in your brain that's not actually helpful. And you really can only be really productive when you're focusing on what you're doing right now. So if you're not focusing on what you're doing right now, you're probably doing a bad job of what you're doing right now. So that kind of perspective has definitely helped a lot. Yeah, I don't know what else. I reckon. Pretty.
Just making an effort to like get out into nature, go to the beach, go for a forest walk. Like, yeah, it's not, because that first couple of months into the start of the trade, and it was working out, and we were just focused on the trade and market news like 24/7. It was just all consuming. And it's not good for your mental health. Like,
No.
You've got to think of the more important things in life. And not be so consumed with your portfolio and the up and down moves of lines. That's all it is. So
and that really hit me the most when the trade was at its peak. So it peaked. Well, hopefully it will peak again, but it did peak earlier when we had the earlier options. We're up something like 85-90% for the year. So that was where it peaked to last time. And at that point,
across the whole portfolio.
Yes, yeah. So our portfolio from we started in January to sort of like April, May, somewhere around that area was up 80-90%. And sort of realizing at that point, like, oh my goodness, this has worked out. We've got this right again. Like, we got it right with COVID. Now we've done this again. What does that mean, basically? Dogs having a... Dachshunds are excellent for your psychological state, that's for sure. They're always bothering you. So it's good. And realizing, having it work out to such a large extent, and realize that I was already thinking very intensely about the next thing that we were going to do. And we were both talking, and we both fell into that path straight away of really focusing on that next thing we were going to do. And then we realized that, look, we've really just got to stop and focus on having that positive state of mind all the time, and then act out of that. So I now believe that instead of feeling a little bit unhappy or whatever and setting a goal and driving hard towards that goal, I now believe that it's most important to preserve your peace and your happiness, as much as you can every day. And then you'll do what you can do. You'll learn as much as you can. You'll think as much as you can. And that's been a much, much better approach, I think. And we've felt a lot more productive mentally, because investing is a mental game. It's totally mental. You've got to psychologically prepare yourself, and you've got to actually think things through in a very thorough, logical way. So that's definitely helped by staying nice and peaceful.
Yeah, I like it. And it's a fascinating discussion, because since you guys put the trade on, you've basically been up the whole time, right?
Yeah, exactly.
And even still, it's this roller coaster of emotions.
Well, it's funny because it's like it goes up, and then the next week it goes down again. Like, it never goes down to what it was, but it's up and down, up and down. And also, if you combine that with listening to market news, which is what we were doing very heavily, you have all these people with like these stories they're spinning to say, all right, guys, time to buy bonds. Let's dive in now. Fed's going to pivot. Everyone believes that as soon as the markets move 10% down, the Fed's going to worry about the markets.
Yeah.
And those people have been around from the very beginning, and they're still around now saying the same things.
Yeah.
And if you let that get to you, then it just adds this emotional toil that doesn't even need to be there.
Yeah, because a lot of these people, they don't actually have not really investors so much. They're more like running media businesses trying to capture attention, you know. Like that's the thing about, and it's very much like, you know, what the content that you put out, Tom, is very much value investing based, like going through the best investors of the world, and it's amazing stuff. But what a lot of the financial news world is about is the most trendy thing, the new thing. You know, well, what's the hot sector? Like we saw it with crypto. You know, the whole, all of our Twitter feeds, all of our news feeds were probably just filled with crypto the whole time.
Yep.
You know, and you can't get away from it. And it's basically, it's like
got me every time.
Well, it never got us, but
bloody Bitcoin wasted so much of my life.
But it does. You start to think, like, is there something to this? Like, you know, should I be looking at this? Like, should I be? You know, I've thought about this a few times and I've researched it, but maybe I'm the one who's missing it. And that's where, you know, you don't want to be closed-minded, but at a certain point, we really started to cull our Twitter feed and cull our news feeds back to people who were experts, you know, in the Federal Reserve, experts in the bond market, investors who actually had positions themselves, you know, people who had skin in the game, basically. And I think that's made a lot of difference, basically. Yeah.
Yeah, cool. I guess if you did get on the crypto bandwagon, you could have a cool profile picture with laser eyes or whatever.
Oh,
that's
please.
One bonus.
Oh, God.
I'm
so proud. Although I do feel like, you know, we are the oldest people in the marketplace at the moment. I feel like an 80-year-old because I'm still against Bitcoin. You know, Druckenmiller's all for it. Like
a little bit, anyway. Yeah.
Who's the rich dad, poor dad guy?
Kiyosaki.
He's all, you know, everyone's gotten on the bandwagon, and we're still like, oh no.
Doesn't make sense. Buy some gold.
Yeah. I don't get it still.
No, look.
I feel like an old man sometimes too with this stuff.
Yeah.
Talking
cool.
Value investing. What's that?
I know.
No, it's very funny. But I think we are going into a time period where cash flow will matter. That's for sure. Because that's the thing about inflation. When you've got those really high interest rates, the valuation, it becomes all about the cash you're getting now, the dividend payment you're getting now. It's not about the future. When you run your valuations and you change things around, you kind of see that. So I think we are going into a time period, you know, like the 70s, where it's all about real assets and companies that are actually doing something. Not what they're going to be doing in 5 years' time, but actually what they're doing right now. And that's, I think, a much more comfortable place for people who are like, you know, regular investors, I think.
Yeah. And that's an interesting point I think you raised last time around how basically people using higher discount rates essentially in their valuations, that's going to have a huge impact on the portfolio. So is that something you were factoring in your broader portfolio kind of outside of this hedge, or were you keeping the core portfolio? Because I know you've got some very growthy stuff in there like Ayr Wellness, even though it trades on kind of cheap multiples as well.
Yes.
Or were you kind of leaving that core portfolio as it was and treating this purely as just a hedge on the side? Or were you doing a bit of both, if that makes sense?
Yeah. No, that's very true. Yeah. So we did adjust the portfolio a little bit. So we did raise a bit more cash. So we were pretty much fully invested when we spoke to you, and we ended up being about 20% in cash throughout the trade. Because with the original coronavirus trade, some of the options we couldn't sell them. There wasn't a market for them, so they had to actually be exercised. We had to buy the stock and then go through that whole process, which takes capital. So that was part of the reason why we thought, okay, well, we don't even know how liquid this market is. Like, we have to actually have some cash aside to do that. So we raised some cash. So we sold kind of, I would say, the most speculative company with the least amount of cash flow, EOS. We sold out of that. It subsequently went up like 30% within a week.
But then down again.
So the story of investing. So, but yeah, we did affect things a little bit. And that is what will probably prevent us from, because when we sell the trade, we're going to have, I'm going to guess, 60% in cash straight away. So when we sell the trade, 67% in a portfolio will be in cash as opposed to 80% invested before. So I think before we go into anything new, we're going to really have to be very careful about where we go with different industries. It's very tempting to go, looking straight into energy because those prices are moving right now, straight into mining or those commodities. And we very well may do that. It makes a lot of sense if inflation is around for a long time. But yeah, I think it's okay to hold ground. That's for sure. And I think that I ran our numbers on from we started. Like we sold our house 6 years ago to now, and we've compounded about 17% a year after tax. It's mostly just the shorts. It's not like, the investing hasn't been a huge part of that. But so our returns I'm very happy with our returns. Like our little business is going quite well. So yeah, we're not in a rush to find something new, fill out a portfolio perfectly again. I think that, again, looking back at a lot of investing in the past, it always would have been best for us just to wait and just to wait for that incredible opportunity that would come along, and then go hard at it, as opposed to sort of trying to overthink it and trying to fill a portfolio when the world is in such, such upheaval. Because until inflation is stable and it's kind of clear where the interest rates are, and they're going to be moving in a huge way, I think there's just still a huge risk out there, that stocks could fall a considerable amount. So you do get that thing where you think, okay, as a value investor, I'm just going to buy based on the valuation that I have. I'm just going to hold. But if you can be patient and get a better price, then that's obviously better. So yeah, I think we'll definitely be nice and patient. That's for sure.
It's not my strong card, but yeah, I'll work on it. I'm still really excited for Ayr Wellness, even though it's just gone down repeatedly since we've been buying it.
Kass was like, is that stock a negative?
Is the stock price negative? Yeah,
it's negative price yet?
It's only ever dropped. But that cannabis in the US could be one of the few growth sectors of the next 5 years.
Yeah,
I still think so. So yeah, we're excited about that one. But
definitely, yeah.
Yeah, cool. And it might be worth digging into Ayr Wellness in a sec, actually, because I think that's a really interesting one. But just for some context for people, I mean, before when you were talking about like a 90% gain in the portfolio, and when you're talking about, potentially having, I think you just said about 60% cash. I mean, when you say the portfolio, this is what you guys do full time, basically. Like that's your entire, near enough to your entire net worth. It's not like you have, a huge portfolio of like rental properties or something on the side, and the portfolio is like 10%. So although you're very concentrated, you're also very risk averse, and I think that seems to have been what's kind of led you to these hedges over time. Has that mindset changed over the past few years, as the stakes have gotten bigger? Like, you can afford less and less to like make a big mistake, I guess, as the portfolio grows. Has that made you more patient?
That's a really interesting question. I think we've become more reliant, less reliant on diversification as a source of, safety, and more reliant on our understanding of situations as a source of safety. Like our business is a good example of that. We really like the people we're working with. We really trust them. They're great people, and we're really enjoying that process. And we're going to grow that business, very conservatively. And we see our portfolio and our business as kind of offsetting each other in a lot of ways. But yeah, I think the temptation, kind of getting back to the psychology part of things before, is as your net worth increases, the temptation can easily be to get more and more fearful about loss, more and more risk averse, more and more concerned that, if you don't just put this in the bank and lock it away, you're going to lose it. And I think that's a trap. It's a big trap. People can result in a really unhappy life. You have to keep doing what makes sense to you. You have to realize that you're in a country where if you lose all your money, you'll get free housing, free healthcare, and free food. So, if you're in that kind of situation, you're in a very conservative situation as it is. And if you're someone whose mind's always working like our mind, we're always thinking about ideas, we're always having ideas, we're always meeting people we want to work with or start something with, and the world's always full of opportunity. So we definitely have a very conservative backing. I think a lot of that came from my grandparents. I mean, my grandparents, are very, very, very good with money. They bought a house when they were just married. They then subsequently moved into their parents' house, and they paid off their house in 3 years.
With the tenants in it.
With the tenants in it.
And they had a
Love it.
baby,
And they had a
and
baby.
they lived in this house with like heaps of people, in one room with their baby, as their tenants paid off their mortgage, and then they moved into their house. So like that's the level of, that's how people used to do things back in the day.
Yeah. And even though that we, we're doing things a bit differently, we feel like we still have that perspective. We still have that perspective that we want to be in investments that we understand so well, and we know the conditions and the risks so well that that's what gives us our security, not so much the fact that, we're just kind of locked away. Because cash right now, potentially is the riskiest asset. And that's the kind of thing that people are sort of still, I think, coming to terms with. I said to someone the other day, and I sort of saw their mind like, what do you mean? And then they kind of got it because of the inflation. They kind of understood that, yeah, actually, you're right. Like, my money is staying the same. Everything's going up. I can buy less stuff next year. You're right. My money is losing value. So when you're in a world like this, no asset is safe. No job is safe. Nothing is safe. You have to actually use that thinking ability and use that kind of, I don't know what you call it, but yeah, just stay active, I guess, mentally, trying to look for risk, look for opportunity, and be on the front foot, I think. Yeah.
I'm just lucky I've got this guy next to me, honestly. You have this.
I think Mitch is luckier to have you, Kass.
I'm very honored. You got no idea, Tom. You got no idea.
100% of our portfolio could have been in crypto at this point.
No.
Like, that's how off the tracks I can get.
No.
But like, Mitch just has this feel for what to stay away from, and when he gets this feel of like, this is interesting, this could be good, like he's just learnt now that to go with it, and even if it's contrarian to everybody else, because you keep doing this thing where you see something, no one else agrees, Mitch sticks with it, and it turns out to be right. So I'm just lucky to have him.
But I think the thing that you've brought as well, this is now the Kass and Mitch podcast. Sorry, Tom, you can just
go for it.
But what Kass brings, which is incredible, is like a rigorousness to the thinking. So I have good intuitions. I can sort of see opportunity, and I can see that something could work. But then Kass is the one who, asks the 100 questions. That every question is a great question, and every question needs an answer. And then we rigorously go through things. So I think as Kass has gotten more interested in investing, and if anyone's interested, she writes great articles about investing too, which you can read. But the rigorousness is actually essential to investing, because you have to go. You can't get your probabilities right if you don't understand all the information. So getting to all perspectives of an investment is definitely the way to go. So I think we're a good team.
Yeah, we'll see. See how we go.
I like it. We always get comments on or on the last podcast we did about how impressive it is for a couple to be investing together as a team and be on the same page. I think it's rare and it's pretty cool.
Yeah, it's pretty weird.
Weird though.
Good weird.
It's very good. But we're more like, I don't know, we go from being like roomies, we have basically sleepovers every night, like we'll play PlayStation with each other, like
we do everything together. That's the thing. It's kind of like
we spend all of our time together, so it's like this is not normal.
Not normal in a good way.
Very good.
I like it. Any final thoughts on inflation before inflation and interest rates? I want to maybe dive into Ayr Wellness for a few minutes to wrap this one up. But any final thoughts on inflation you want to get out there?
Yeah. So there's the big argument about, is this supply chain? Is this supply caused, or is it demand caused? Right? Or is it all the Federal Reserve? And we honestly don't know. We don't know. It's impossible to know. You can't know. But my opinion at the moment is that the incredible amount of stimulus that was done during COVID basically kicked off and exposed what was a lot of misallocation of capital over a number of years because of low interest rates. So because the rates were so low and it was so cheap to take on debt and just like buy back stock and basically do financial engineering, I think a lot of these industries that we're now seeing shortages in, whether it be coal or gas or whatever it is, any commodity where we're having shortages, oil, there's not enough oil being produced, whatever it is, it's very kind of it's very hard to see how that's from the Fed printing money. But if you go back and look at how long the rates are being suppressed for over the whole world, I think that the cause of inflation, the real cause that will sustain inflation, is this misallocation of capital, of not investing in real things that we need, real assets, And we're as worried about climate change as anybody. It's a scary thing. Like we saw not too long ago, there was a day in Antarctica that was like 5 or 6 standard deviations hotter than it should have been. So we're getting these things happen around the world where spikes in temperature that are really improbable, and that's a very, very scary thing. But in that transition from dirty energy to clean energy, we're going to need a lot of raw materials to do that. And because everyone was focused on ESG and focused on making your company look as friendly as possible, basically, I think people have really not invested in those kind of industries. So basically, to fix the inflation, the demand has to come down a lot, and it may be more than any of us realize. They had three recessions in the 70s, so it's not as if a recession will solve inflation. It may not. They also got rates to 11% when inflation was, I think, 9% in 74. So they actually got rates up there, and they had a recession, and inflation came back. So inflation's a very, very hard thing to solve, and with all these supply issues for commodities as well, we think that the probabilities are that it does sustain for quite a long time. And in that world, I mean, everyone's portfolios are going to need to look really, really, really different if that's true. So unfortunately, macro is very scary for a lot of people, and it's very confusing and whatever. But at this point in history, it might be the one factor that we need to understand to sort of navigate the future safely, I suppose. Yeah.
Yeah, and I think Bridgewater believes that the Fed will try and tackle inflation, but it might not even be possible.
Yes.
That we might just have to get used to a higher level of inflation permanently. Yeah. So that's a whole new world from what we're used to.
Yeah.
So yeah, it's hard to know what to do, really.
Bridgewater's opinion is that the Fed will try and stop inflation, and which you believe that when you hear Jay Powell talk. If you listen to him for 45 minutes at the press conference, like, he's very serious that he's going to get that inflation back to 2%. But on the way at 2%, if he's forced to raise rates 5-6%, and that causes incredible pain to the economy, then he may have no choice at that point to sort of slow down and then accept a high level of inflation, maybe 5%, maybe 4%. And if we accept that high level of inflation, maybe that be a kind of a moderation of the two kind of worst outcomes. But that's kind of what makes sense at the moment, and it could change. It changes constantly based on how bad inflation's going.
And also now that it's kind of in people's psychologies, it's really hard to try and predict what's going to happen, because every average person now knows about inflation. It's a thing affecting them. They have to pay for fuel. Rent's gone up.
Yeah.
It's a common day thing now. When that starts circulating, that's on a psychological level, that's like the most sinister of all.
Yeah, I completely agree. I mean, everyone's seen it in their everyday lives, I'm sure. Like, everything's just more expensive. People are asking for bigger salary increases, which is a pretty hard thing to reverse. And it's just kind of it's front of mind for a lot of people, I think. Maybe more so for us because we're like finance nerds, but I think it's there for most people.
It's hard to remember what the normal person thinks about these days.
I know. That's why we've got a couple of really nice people we're friends with, and it is good to just like talk to them about non-finance things and realize what like a regular nice person is thinking about. So it's good. But I think people, you're right, Tom, people are noticing that getting a 4% pay rise is probably not enough. You should probably be asking for more than that. And that, because we're not having the immigration, and if we do have the immigration in Australia, for example, we've already got 1% vacancy rates with our property market. So if we do, bring over a huge amount of, let's say, cheap labor or immigration from other countries, then where are we going to house everyone? That has its own pressures. So basically, everything's gotten out of whack. Everything's gotten hugely out of whack, and every time we go through like an individual problem, an individual situation to do with inflation, you start tracing it back. Start tracing it back to the causes and the sub causes and things that are like way far back. You realize, geez, if you actually, as an entrepreneur, you're trying to think, how would I solve this problem? You just give yourself a stomach ache and you just want to go to bed and just not think about it because it's an absolute nightmare. So I'm sure it will get solved eventually, but it's not clear to us how long it will take
and what it does to everything in its wake.
Yeah,
it's tough. Well, let's do something. Let's change tack slightly and talk Ayr Wellness. I think that's a really interesting position in your portfolio in the cannabis sector, which is miles outside of my personal circle of competence, I must say. But some of the some of the people don't believe me when I say that. It is true.
It's that beard, Tom.
yeah. But it's the beard and hoodie and headphones, I guess. I don't know.
Yeah.
But some of the valuation numbers and the growth is kind of insane, and and makes me want to take a closer look at it. So what's the high level kind of summary of the idea on Ayr Wellness?
Yeah, mate. So first point, I would say we are down 70% on our Ayr Wellness. So take that into consideration before you listen to everything we've got to say. But basically, cannabis consumption in America is growing at 15-20% a year. More states are always legalizing every month. When they legalize and they go back, it's been long enough now that there's a lot of research out as to the effects of legalization on a state, and the effects are that taxes go up, opioid deaths go down, alcohol deaths go down, and
crime goes down.
Crime goes down as well in some states. Nothing bad really happens. So that trend and the evidence of that, the overwhelming evidence of that, has basically meant that it's now become a Democrat and a Republican issue. So 70% of Americans, I think, believe in full legalization as an issue. So it's one of the most bipartisan issues in America. So there's a huge amount of people in America that want it legalized and see it as basically a good substitute, has health benefits for many different kind of ailments people have, basically. So that's the high level view of the industry and sort of how it all is working. On a stock point of view, the stocks all trade at like cash flow multiples going forward of between 3 to 6 times cash flow. Now, as far as what the profitability of cannabis will be, as a business long term, no one knows that. And we don't know that either, because in where it has been legalized in Canada, it was done in a very different way. They didn't really have the kind of vertical integration that they have in America. America has a lot of unique dynamics around, why it makes sense as an investment in America as opposed to Canada. So cannabis in Canada is not the same as cannabis in America. But basically, if you think about it, like all the businesses Ayr Wellness, for example, they're totally vertically integrated from when they grow the plant to when they actually have it in the dispensary. And they're actually starting to build brands now around, cannabis drinks that have no taste, cannabis, other, edibles and things like that. People can have and can use to sort of help to get to sleep. And there's a whole bunch of other benefits for that, basically. So as far as long-term profitability, no one really knows, but the forecast of the company, Ayr Wellness, that we own shares in for next year is $250 million of cash flow. And the market cap is, I think, $550 million last time I looked. So we're now approaching 2 times cash flow. And that's cash flow after a huge amount of government regulation. They pay a tax called 280E, which is basically a federal illegality tax. I'm not sure if it's like 10, 20%, something like that. 20%. So they have huge amounts of taxes. They're still using cash in their business, a lot of businesses, because they're not allowed to use federal banking. So if any of these things get removed, and considering it's so, so bipartisan and so accepted that that would be a good thing. Just recently, it looks really promising that they will get some of those banking reforms through. Um, a senator from a Republican senator who was very pro-cannabis actually beat a Trump-backed candidate. I think it was in South Carolina. So Republicans are actually behind this as well. And it's possible that Republicans may take it from the Democrats as an issue and actually pass some of these laws that would potentially enable uplisting. So uplisting at the moment, when you try and buy shares of Ayr Wellness, you need to get interactive brokers. You probably can't do it through ANZ or CBA. You need to get interactive brokers as a different way to buy shares. And so basically, they're not on the NASDAQ, they're not on the normal exchanges. So it's possible, but not certain, that when these banking laws get pushed through, these companies will be uplisted onto the NASDAQ or other of the large exchanges, and that would enable large funds to actually buy shares in these companies for the first time. And so, obviously, like, valuations have been pretty stretched, but 2 times cash flow is very, very, very low for any business, even if the profitability is kind of uncertain in the future. So that's kind of where it was a large position for us. I think it's gone down a lot. So it's probably like a 10% position, and we bought more a little while ago. But yeah, we feel the finances of that company are pretty solid, and we think it's pretty good.
And also just like the general economy, speaking, it's an essential service. So they carried on all through COVID lockdowns. All their revenue remained pretty consistent through that whole period.
Yeah.
I think it's like the service that people need. And it's a service also that would generally gradually replace alcohol, replace tobacco. There's a lot of like black market funds now coming into the legal, arena. So there's like a consistent level of demand there for the product.
Yeah. And most people
through inflationary periods.
Exactly right. And I think it's quite, because if you think about other kind of chemicals that, we all ingest, for example, caffeine is one, that's become, people weren't, maybe they were originally chewing cocoa beans, and maybe most people didn't want to do that because that was quite unpleasant, so the form factor changes over time, but the underlying chemicals are what get kind of repackaged, and eventually they find a form factor that fits with what people are happy to accept. And Ayr Wellness has a very popular drink called Levia, which is a seltzer basically that has no taste. And it is a competitor for alcohol. And considering, from the research that, we've read about, it has no hangover basically. So it's a strong competitor. And I think that's why you've got a lot of opposition to it as well from the pharmaceutical industry, from the alcohol industry, because they realize that this is a large threat to their businesses. So kind of, I guess, just keeping abreast of and watching the political developments has been very interesting. And I guess we're just going to hold, and we're just going to sort of see where it goes. And we feel that over time that there's a good chance it could be legalized. Yeah.
Yeah, cool. And I'm not sure whether you know the details on this one, but so Ayr is vertically integrated, so they go from kind of growing the plant right through to final product, and they have a number of stores in different states, right?
Correct.
Is that right? So we're presumably they're capturing some sort of margin versus if they were outsourcing each of those different aspects of growing and so on. Is there any sort of particular part in that vertical integration that kind of adds the most margin versus allocating all your capital towards just opening new stores, for example, and outsourcing the growing? Or maybe the growing is where the money is and then you make a great margin on that and it's worth expanding kind of just that aspect of the business? Do you have some perspective on that?
Yeah, that's a really interesting question. I think that the branding is just starting. So people have mainly just been, historical cannabis consumers, and they just buy the flower itself. Whereas now a lot of people, older people who have, inflammation or back issues or trouble sleeping, they're much more comfortable, coming in and buying a tea or a drink that's infused. And I think that just like Coca-Cola. You look at Coca-Cola. Coca-Cola is essentially caffeine and sugar. It's a very simple product, but it's the branding that has resonated with people, over time. I think that the best margins probably come from the branded products, and Ayr Wellness is investing a lot. They've, a lot of cannabis companies, they'll have dispensaries in all different states, but they'll have all different brands. And Ayr Wellness is actually, trying to keep it pretty constant across their whole portfolio as to what their brands look like and what the experience of their brands are. And I think that has a good chance of, creating some loyalty with their products. But yeah, as far as the margins of the individual sections of the chain, that's a good question, but pretty uncertain, unfortunately, at this point. Yeah.
But a few states that they're in, you have to grow.
Yes.
Like you can't just open a dispensary and sell someone else.
Right.
Florida, for example,
you have to
can't
grow the product and have the whole. That's part of the limited licenses,
exactly.
The rules of it.
Yeah.
Right, and is that's just like
monopoly.
Yeah, cool, and that's like a quality control thing or something.
It's part of the state laws. So as the kind of campaigns went through each state, I think they kind of just like did the best they could based on the negotiations. That's why it's all a bit, higgledy-piggledy across all different states. But yeah, most states have that rule that you have to grow yourself if you want to sell it yourself, pretty much. Not California, though. I think California is a bit of a free-for-all, and that's why Ayr Wellness has stayed out of California. And a lot of the big companies have stayed clear of California because it's sort of like there's a lot of illegal product growing there as well. So there's just a massive flooding of the market. But states like Florida, I think it's, what's the other one? Boston is a state that Ayr's quite strong in. They've got some stores in really good locations.
They've got a dispensary next to the Apple store in like the main street.
I had heard that.
Boston.
Yeah, that's
They
pretty
do.
crazy.
They talk about it every call.
They talk about it every time. It's next to the Apple store,
Yeah,
So,
I wonder what order people visit those stores in, whether they go buy an iPad and then wander across the road, or maybe they go to Ayr's dispensary first and then decide they need a new laptop. I don't know. Maybe it benefits Apple as well.
Maybe
Definitely
it does.
would be, yeah.
Maybe it does. Oh man, I thought you guys had apples here. Like,
we're hungry.
Yeah.
Oh, boy.
Okay, one last question on Ayr from a sort of stock perspective. So you mentioned
sure.
they're at roughly 2 times cash flow at the moment. I know one of the things, kind of red flags initially that jumped out to me was they've got quite a lot of growth, and maybe you can speak to what sort of rates they're growing at the moment.
Yeah.
But a lot of it seems to be through acquisition using stock as the currency to make those acquisitions, which presumably you'd think is cheaper source of funding when your stock's at 2 times cash flows.
Exactly.
Wonder if you could speak to that a little.
Exactly. So they did raise a lot of capital at higher levels in share price. I think they pretty much top ticked their share price in raising a fair bit of capital. Nice. They then used that capital to pay about 4 times earnings for a number of operations. They bought the second largest company in Florida, Liberty Health, which I think has 60 dispensaries or thereabouts, maybe 45, somewhere around that, 40 dispensaries. And they also bought a company called Tahoe Hydro, which is basically high-end production. They won a lot of awards for the quality of their product. So the share issuance, to create revenue growth is can be a real danger sign when companies, I think, are overpaying for acquisitions. When they're paying reasonable prices, it's not really so much of a concern, because you can only, there's only 3 ways you can buy a company. You can use your cash flow, you can use debt, or you can use your stock, basically. So as far as cash flow goes, they've been building a lot of back-end support, I guess, for their dispensaries, because they plan to grow their number of dispensaries over time. So it's important to have the supply built out. And according to them, they're now 95% through the actual CapEx. So that's where the kind of investment perhaps might have been de-risked a bit now, because they have actually gotten to the end of that build process, which is really nice for us to hear, with inflation being a factor, because that's something we were concerned about. If they're still in the middle of these construction projects and they're having to pay, exorbitant prices for construction, that could swing things, basically.
Yep.
But yeah.
Cool. I like it. Interesting one to take a look at. Well, Look, I really appreciate you guys coming back on the podcast. I think it was cool how we kind of had you on last time to do a bit of a
Yeah.
preview to a hedge you were looking to do. It was really cool talking through the COVID one, but that was after the fact, So getting one in real time was pretty epic, and you guys have crushed it. So, yeah, appreciate you both taking the time. I know you're both reasonably active on Twitter. You've got the podcast, and Kass, I know you've got a Substack. I've been reading a little bit as well. Do you want to give those all a bit of a plug before we wrap it up?
Yeah. What's your Twitter again? Cassia_Dol or Kass?
Cassia_Dol with a K. So it's KASSIA_DOL.
Yep. And I think I'm Mitch_Dol, not Mitchell. So Mitch_Dol DOL. And the podcast is Buffeting. And I think if you find us on Twitter, I think we have like a little link tree thing. So you can just hit that link and it just goes to like all the podcasts and YouTube and Kass's articles, which are amazing as well.
Oh yeah, my Substack is Macro Micro Girl. But I've been a bit slack with that. I haven't written in 2 months, but yeah, well, it's all part of the Zen process. So being too busy meditating. So
yeah,
that's true.
I like it. Cool. Well, I'll link all that down in the show notes or the description below, depending what platform people are watching or listening on. But thank you both again. We'll have to do this again soon.
Absolutely.
Our pleasure, Tom. We always love chatting to you. So yeah, look forward to the next time we find something good.
100%. Thanks for watching another episode of the Investing with Tom podcast. If you did enjoy it, be sure to subscribe so that you can see future episodes as soon as they go live.